It has just been 7 months since Britain's transition out of the EU was completed. However, talks between London and Brussels on establishing equivalence for financial services regulation are still ongoing. In the coming months, proposals to refine capital markets regulation will be laid out by the EU Commission, while in the UK, the Treasury is consulting on broad themes of capital market reform and commissioned an independent review of the UK's fintech sector in the form of the Kalifa review. Many market participants hope both sides' regimes remain closely aligned, but the UK government has made it clear that post-Brexit Britain wishes to push ahead as a sovereign jurisdiction with its own priorities. Joining me today to discuss the future of financial services post-Brexit is Kay Swinburne, Vice Chair of Financial Services at KPMG UK. Hi Kay, thank you for talking with me today.
Hi Aaron, good to be here.
So to kick things off, I wanted to ask you about the future of the EU's Capital Markets Union project. So obviously deeper and more integrated capital markets should lower the cost of funding and make the European financial system more resilient in the event of another financial crisis. But is the EU still on course to deliver on its Capital Markets Union plan, or are member states' various financial centres at risk of greater fragmentation post-Brexit?
So the original Capital Markets Union plan was obviously launched by a UK commissioner when the UK was very much a member state. And therefore the largest global financial centre within Europe was actually sitting within the group. Now that you're actually facing a very different situation where the largest financial centre has now left and the UK therefore is now sitting outside of the bloc, it does mean that the CMU that was originally launched is probably not the CMU of the future. And so bearing that in mind, is it on track? I would say it's advancing. There is some progress towards a more unified, harmonized system for raising capital in the EU 27 markets, but it's still highly fragmented. And I think it will continue to be highly fragmented because each member state almost competes against one another in order to have companies list in their jurisdiction and raise capital within their borders rather than within the EU as a whole. And so for me, until you get to the stage that there is one legal system, one basis for tax, for investments and for listings in the EU, then you're not going to have one system of a capital market, a true union. You're going to end up with 27 distinct capital markets instead. I don't think they're making as much progress as they could be. Although when you have one exchange group buying up other exchange groups throughout Europe, certainly within the equity markets, it becomes easier to see how you can get a bit of harmonization through that market consolidation. But that isn't for me what Capital Markets Union was about in the first place.
Okay. And I know you've written about this extensively, but I wondered if you could outline some of the other factors at play influencing the development of a true Capital Markets Union across the EU.
So in particular, I would say there are old legacy issues and then there are the new forward-looking ones. And on the legacy issues, I don't think the EU has done terribly well because they've basically tried to avoid doing the insolvency law harmonization that really should have happened many, many years ago when the original barriers to entry for this capital market formation were done. And I'm talking 20 years worth, where they identified insolvency law was an issue, the withholding tax was an issue, and then other parts of that where you genuinely share the same structures, both legal and commercial structures, for actually having one true market operating. Those haven't been touched, and indeed they've been put in the too difficult to deal with box currently. So they're looking forwards instead, and that forward-looking agenda has more chance of having a unified system. So in things like the new digital agenda and in the green finance agenda, those are two things that the Commission have already put proposals on the table. They've put a series of suggestions as to how you can have a unified system. And I do believe that they will make significant progress in those two new areas, given that they're future-looking rather than retroactive. And it's that rearguard look at the current markets, particularly equity markets, that is the problem for Europe. The forward stuff, I think they'll do well at.
And moving on slightly, I mean, the EU Commissioner for Financial Services, Mairead McGuinness, has consistently said that the EU has no intent on stealing business from the City of London, despite the bloc looking to shift clearing of euro-denominated derivatives to Frankfurt. However, she did admit that the future access for the UK to the bloc's financial market will ultimately hinge on Britain's commitment to regulatory equivalence. How do you see UK financial services regulation taking shape post-Brexit? Do you think it will be a rule taker or a rule maker?
So I'm going to separate that question into a few parts. The first being that a global financial centre cannot ever be a rule taker. And so when the UK was part of the EU, it was very much part of the rulemaking process. It was never a taker of rules, it always shaped those rules. So as a global financial centre outside of the EU, it cannot possibly take another region's rules that will be devised only for their purposes, not for the UK's purposes, and specifically for the UK wholesale market. So I don't think they will be rule takers, and nor should they be. The reality here, however, is that the EU rules move on a regular basis. So every piece of legislation within the EU has an inbuilt review clause, and that inbuilt review clause is usually 2 to 3 years after implementation. So you've got some significant pieces of capital markets legislation up for review, including MiFID II, the very large piece of market structure infrastructure that is actually the basis for all the capital markets legislation across the region. That's up for review this year, a year later than it should have been because of the COVID crisis. But those will be significant changes. So my question would be, what is the UK trying to stay equivalent to? And the process by which it gets its equivalence is determined by different pieces of legislation. And I think in the UK, we tend to talk about equivalence as if it's one overarching determination that the UK financial services ecosystem as a whole in every aspect is equivalent to the EU. And indeed, that's not the way that equivalence works. Every single third country access provision is in a different piece of legislation that determines whether or not a jurisdiction gets made equivalent or not. And in this case, they're deciding case by case basis when it suits the EU whether the UK meets their determination. So I don't think the UK can do much in terms of the future equivalence, because the EU's legislative programme is changing all the time anyway. You cannot stay in lockstep with it, and therefore there will be a natural change. But equivalence was never designed to be line by line. It was always supposed to be that you trusted a jurisdiction's regulatory framework, that they were coming to the same outcome as the EU's intention was with their legislation. And if we go back to that, I would expect the UK to have equivalence very quickly. Of course, that's not going to happen because it's become a politicised system. And therefore, the UK needs to do what's right for its markets. And I would hope that the same players are lobbying in the same direction, both in the UK, the EU, the US, Singapore, and other capital markets around the globe, to make sure that best practice is actually served in the wholesale markets, wherever they may be. And so I genuinely think there will be differences, but I would hope that the outcome is not too different.
Building on that again, then, obviously the UK seems intent on taking advantage of its new autonomy and diverging from EU financial rules to make the City of London more attractive to investors. How do you see the UK developing as a non-EU financial centre moving forward?
So I think even if the UK did nothing to change its financial regulation right now, then the EU is changing all of its financial services legislation as we speak. There are significant proposals on the table this year in order to actually do rule changing. So even if the UK did nothing, it would actually be diverging just by default. So for me, it's not a question of what the UK is going to diverge in. It's going to be a case of, if the UK looks branch and sort of root and branch all the way through its financial services rule book, is all of that relevant to a single capital market in the UK that serves global clients? And I would argue that probably and possibly some of that isn't relevant anymore. When you're no longer part of a big trading bloc, you're now just a single country with one single rule book. I don't think you need some of the complicated rules that were there to try and get harmonization amongst 28 countries. So there will be changes, and I think there will be efficiencies. The retail market in the UK, by and large, is subject to significant conduct rules through the FCA, and there's a lot of consumer protection. Therefore, the wholesale markets can operate differently because in most cases, retail investors do not access the wholesale markets directly. They do so through a professional intermediary. So for me, we can now concentrate in the UK on wholesale market rules that work for professional investors and professional players and market participants. That means they will be different. They don't any longer have to take into account the retail Italian bondholders, for example, which is one of the key things when MiFID II was being devised, had to take into account these retail markets in different countries. If you don't have to do that, the rules will change. And I would hope that they become more efficient. They have codes of conduct that are relevant to professional investors, that they actually have best execution that are relevant to professional investors, rather than trying to combine and blend the professional and the retail investment protections within them. So just removing that will remove a big layer of red tape for those companies. And I do hope, therefore, that the rule book will be simplified. I don't think it's deregulation in any way. It's just a simplification and a relevance and a proportionate application of the rule book.
Can I ask you how much EU business can still be done through London post-Brexit, given the environment that we're in?
So London has always been a global financial centre, and it was the location of choice for much of the EU's activity for capital markets. So whether that was in the primary or secondary markets, it often was the venue of choice. And indeed, even on the secondary markets for equities, for example, when MiFID I was originally put in, most of the MTFs, those alternative trading venues, came to London to set up. And so the vast majority of the MTFs for Europe were based in London. Of course, because of the share trading obligation, the EU has now forced that trading to take place in venues located in the EU for those secondary trading markets. That has meant significant volume has moved into the EU, but it does not mean that people who are actually based elsewhere in the world, who are trading European stocks, or indeed trading any stocks, can't trade those through a London operation. And so a global trading centre needs to remain that, an open centre, open to global activity. And it doesn't matter where the instrument is in the world, London should be an attractive venue for that trading to take place, and indeed for the post-trade to take place. Much of the post-trade environment in London has come about because it's an ecosystem. You can actually net your risk off various transactions in London in a way that you can't elsewhere. And so I do hope that that global financial centre really is the focus for the UK's regulatory adjustments to make sure that it stays open for business and that we don't put too onerous a demand on those entities who trade and obey the rules whilst they're trading in the UK, or indeed have a post-trade activity, but they don't need to necessarily be regulated by the UK to do so.
And speaking about that global presence, is there scope for the UK to focus on building closer ties with the US on financial services post-Brexit?
I think the UK as a global financial centre already does have significant dialogue with other global financial centres. The UK and the US were always very, very close and had sharing arrangements between the regulators, the US regulators and the UK regulators, beyond anything that the EU and elsewhere in the EU had. So whether that was the Commission or indeed other member states. I expect that to continue and to deepen. And I would envisage that over the coming years, there will be dialogue as to whether this can be formalized. So it goes more into some form of a trade and investment partnership with the US. So we formalize that arrangement for market access rather than just have it through the regulators and their dialogue. If we look at where we are at the moment with the UK negotiating with the Swiss, they're negotiating an advanced mutual recognition arrangement, where instead of, as the EU would refer to non-EU countries as third country access, the UK is looking with Switzerland as to whether they can determine something they're calling second country access, where indeed they treat them as a much closer sort of ally than they would anyone else. And so to have a serious, genuine mutual recognition system whereby it's built into an agreement that they recognize each other's regulators, they recognize each other's rule books, and they defer to one another. And that full deferral is an important part of that closer relationship. If you can do it with the Swiss, I would suggest you can do it with other closely aligned markets like the US, and potentially into other markets like maybe Canada, Australia, and indeed Singapore, Hong Kong, and maybe others.
And just shifting focus slightly now to the future of UK fintech. Do you feel that the recommendations made in the Kalifa review are robust enough to ensure that the UK maintains its position as Europe's leading fintech hub?
So I've been delighted with the data so far this year that shows that London is still continuing to be the location of choice for investments and for firms to be setting up in the UK in the fintech sector. That, of course, relies upon the UK having a really good ecosystem going forwards in the new digital capital markets of the future. And indeed, the Kalifa reviews were very comprehensive. So the recommendations were broad and in many instances were very specific. So there were some very detailed requests from both the government and from the private sector to help develop new systems. So whether that's a framework for AI, whether it's a framework for cryptocurrencies, a development of the CBDC so that the central bank really does lead and is seen to be leading in that digital asset space. All of these recommendations go into, and in the policy and regulation chapter that I helped write went to 25 pages of recommendations. Many of those have already been accepted by both the Treasury and indeed by the regulators, whether that be the Bank of England, the PRA or the FCA. And it's really noteworthy that all of the regulators have now got individuals who are tasked with implementing the Kalifa review. So they're taking it very seriously, and where they can, they are making the changes that will actually enhance that ecosystem for fintech in the UK. I am really pleased with the response, both by government and regulators. There's more work to be done. And I think the piece of work that's going to be very difficult is where we need government departments to work together. It's not easy to get different government departments with different focus to actually come together to work. And we suggested a digital economic task force would be required to do it. Not sure they're going to deliver that. And I think the private sector is also expecting to have CFIT, which is Centre for Financial Innovation and Technology. I don't know whether the private sector will get that off the ground either. So these facilitators need to happen, because in the case of something like digital identity, you need a personal digital identity and a corporate digital identity to work side by side. And the review found that the only real way to pull that together was to get 6 or 7 government departments working in unison to actually deliver one framework the private sector can then lean into and help deliver it for the UK as a whole. I'm still hopeful it can happen, but it needs that partnership. And I think collaboration between public and private sector in that space is going to be paramount to actually really getting delivery on all of the Kalifa recommendations.
So you almost answered my final question as well. So from previous reports on bobsguide, many of the recommendations outlined in the Kalifa review have been well received by incumbent financial institutions and fintechs alike. But both parties expressed concerns about how the new initiatives outlined in the report will ultimately be implemented by the government. What does the UK government need to do to ensure the recommendations are implemented correctly? I think you touched on it in your previous answer, but if you could just build on that point.
The interesting thing for me was that the Kalifa review was very much a fintech stakeholders review. So everything that was in that didn't come from those of us who wrote it. It came from the fintech sector. And so it's very much a bottom-up industry view on what is needed. The interesting thing, as you've noted there, is that the financial incumbents have also welcomed the findings, which means that the entire financial services ecosystem are now supportive of these initiatives. And we're also hearing that the tech firms are also supportive. So we've now got a really willing private sector set of participants. Government are showing very willing in certain areas, and in areas that are in the gift of HMT, I would actually give them full credit that they are moving full steam ahead. It's those areas where they need other government departments to lean in. So I would suggest that they need, on the digital aspects of this, to actually get that cross-government departmental working. That's the area I have most concern, that if we fail to deliver, the UK gets left behind. We need to be at the vanguard of this. And the future digital asset, raising capital through tokenization, doing things differently, doing things in a new, efficient way using, digital ledger technology. All of these things are what I would like a global financial center to lead on. And that needs government departments to work together. So I'm hopeful it can happen. It just needs, I think, a little more industry pressure to make sure that it is delivered.
Thank you. Well, thank you very much for answering all my questions, Kay. And also thank you so much for your insights and above all your time. It was a pleasure speaking with you. Thank you so much.
Thank you, Aaron.